We're going to look now at exercise 1811. In 2018, Borland Semiconductors entered into the transactions. We're going to look at in 2015, Borland had issued 170 million shares of its $1 par common stock at $34 per share. Assuming that Borland retires shares it reacquires, record the appropriate journal entry for the following transactions. So the first one is on January 2nd of 2018, Borland reacquired 10 million shares at $32.50 per share. So they were initially sold or issued at $34 per share. So we're going to debit our common stock for only the par value of $10 million per share, 10 million shares. The paid in capital in excess of par, since they were issued at $34 a share. The 34 less the par is 33 a share. So the paid in capital in excess of par is going to be $330. We're going to credit our cash for the 10 times $32.50, which would be $325. Then we're going to credit our paid in capital share repurchase for the difference between what we had originally issued it for minus our cash. The difference is going to go to paid in capital. Now on March 3rd of 2018, Borland reacquired 10 million shares at $36 per share. Again, remember, they were issued for $34 a share. So we're going to again debit our common stock for the par, debit our paid in capital excess of par for the difference, the 34 they were issued for minus the par, puts the difference, the 33 at 10 million in paid in capital in excess of par. Then we are going to take our available balance in the paid in capital share repurchase, which is available for 15, debit that. And the remaining balance is going to go to retained earnings. We credit our cash for the entire 10 times $36. On August 13th, Borland sold 1 million shares at $42 per share. So we're going to just treat it as though this was the initial issuance, where we are going to debit our cash for the full amount, credit our common stock for the par value, and then we credit the paid in capital excess of par for the remainder. Then on December 15th, 2018, Borland sold 2 million shares at $36 per share. Again, we debit our cash, 2 million at 36, credit our common stock for the par, and then we credit our paid in capital for the excess. Now let's look at a problem similar to 18-2. So the shareholders' equity section of the balance sheet of TTT Systems, Inc. included the following accounts at December 31st of 2017. So as you see here, we've got our 400 million shares at $1 par, the paid in capital excess of par, 3,200. Paid in capital share repurchase has a balance here of $1, and the retained earnings of 3,000. Now they're all in millions, I'm just keeping it simple. So then during 2018, TTT Systems reacquired shares of its common stock and later sold shares in 2 separate transactions. Prepare the entries for both the purchase and subsequent resale of the shares, assuming the shares are retired. In this slide, we're going to show that the shares are retired, and then in the next slide, we're going to show them as treasury stock. So the first scenario is on February 5th, 2018. TTT Systems purchased 8 million shares at $12 per share. So what we'll do in this scenario is debit our common stock for the par, debit our paid-in capital for the excess of par. We're then going to debit our paid-in capital share repurchase the available balance above of 1. We're going to credit our cash for the full amount, the 8 million times $12 per share, and the difference will be then debited to retained earnings. Then on July 9th, the corporation sold 2 million shares at $14 per share. So we're just going to treat it as an issuance, debit our cash, credit our common stock for par, credit our paid-in capital excess of par for the difference. Then, see November 14th, 2020, the corporation sold 2 million shares at $9 per share. Again, we're going to do the same thing. Debit our cash for the full amount, 2 million at $9 per share. We credit common stock just for the par, and then credit our paid-in capital in excess of par. Now, this scenario treats it as treasury stock. In this case, we're going to, when we repurchase, we're going to debit the full amount to treasury stock, credit cash. Then, when we reissue the shares, we want to make sure that we credit the treasury stock for the amount that we showed the stock to be when we initially repurchased it. So, if we repurchased it for $12 a share, we need to make sure that we credit the $12 a share as a credit against treasury stock, and then the difference goes into paid-in capital for the share repurchase. So on July 9th, we debit our cash, 28, we credit our treasury stock for the portion 2 times 12, because that is what we had initially repurchased it for, and then we credit the difference to paid-in capital. Next, on November 14th, we're going to show that we issued them for $9 a share. So our cash is the 2 times 9. We need to make sure we credit our treasury stock for the $12 a share. So 2 times 12 is the credit to treasury stock. Again, remembering what we had initially repurchased them for, we need to wipe out or zero out that portion of the balance against treasury stock. Then the paid-in capital shares repurchased, we had the original balance of 1 million in our paid-in capital shares repurchased. From the above transaction, we had 4, so the 1 plus 4 we can offset with 5 million as a debit to our paid-in capital shares repurchased. And then the remaining amount the difference will go as a debit to retained earnings. So in this scenario, what is our shareholders' equity balance ending accounts if we go the retirement, or if we retired the shares, or if we treat them as treasury stock? So as you see in this scenario, under the retirement, the retained earnings is going to be the $3,000 minus the $23,000 that we had debited in the journal entries previously. The paid-in capital excess of par is going to be the $3,200 shown originally minus the $64 plus the $26 and plus the $16, just following the journal entries to come up with the new balances. If we treat it as treasury stock, remember our common stock par does not change. We don't debit our common stock like we did when we retired the shares. We debited treasury stock. So in that scenario, we have our less our treasury stock of minus 48. Remember, it's a contra account. And our retained earnings would be the $3,000 minus the 1 gives us the $2,999,000 in the retained earning balance utilizing treasury stock. So let's go through another problem here. The following partial information is taken from the corporation balance of Luther Corporation. How many of Levi's common shares were outstanding on 12/31/2017? So we can see the difference of 12/31/2017 and 12/31/2018. How many were outstanding? So 30 million shares were outstanding as of the end of 2017. 31 million were issued, and 1 million shares were in the Treasury. So, in the previous section, we looked at invested capital. Now we are going to consider earned capital, which is retained earnings. In general, retained earnings represents a corporation's accumulated undistributed net income or net loss. A more descriptive title used by some companies is reinvested earnings. A credit balance in this account indicates a dollar amount of assets previously earned by the firm but not distributed as dividends to shareholders. So we refer to a debit balance in retained earnings as a deficit. Microsoft reported a deficit for several years until retained earnings grew to a positive balance in 2013. So again, let's look at a concept question. Which of the following statements is true regarding retained earnings? A. Accumulated undistributed net income results in a credit balance in retained earnings. A more descriptive title would be investment earnings. Retained earnings represents accumulated distributed net income. Or an accumulated deficit results in a credit balance in retained earnings. So what do you think there is the correct statement? Well, hopefully you got A there. As a component of equity, retained earnings always has a normal credit balance, so the accumulated undistributed net income results in a credit balance. Let's look at another one. Roberta Corporation was organized on January 1st, 2018. The firm was authorized to issue 84,000 shares of $5 par common stock. During 2018, Roberta had the following transactions relating to shareholders' equity. Issued 10,900 shares of common stock at $6.30 per share. Reported a net income of $109,000. Issued 19,800 shares of common stock at $9.20 per share. Paid dividends of $59,000 and purchased 3,300 shares of treasury stock at $11.20, part of the 19,800 shares issued at $9.20. So as you can see, when you total the issuance of stock, then you add the net income, subtract the dividends, and subtract the treasury stock, you will notice that the correct balance would be the $263,870. Okie doke. So shareholders' initial investments in a corporation are represented by amounts reported as paid in capital. So one way a corporation provides a return to its shareholders on their investments is to pay them a dividend, preferably in cash. Dividends are distributions of assets the company has earned on behalf of its shareholders. If dividends are paid that exceed the amount of assets earned by the company, then management is basically returning to shareholders a portion of their investment rather than providing them a return on that investment. So most companies view retained earnings as the amount available for dividends. In unusual instances in which a dividend exceeds the balance in retained earnings, the excess gets referred to as liquidating dividends because some of the invested capital is actually being liquidated. This might occur when a corporation is being dissolved and assets that aren't subject to a superior claim by a creditor are distributed to shareholders. Any portion of a dividend not representing a distribution of earnings should be debited to additional paid-in capital rather than to retained earnings. Sometimes the amount available for dividends purposely is reduced by management. A restriction of retained earnings designates that a portion of the balance in retained earnings is being unavailable for dividends. So companies may restrict that retained earnings to indicate management's intention to withhold for some specific purpose the assets represented by that portion of retained earnings balance. An example could be management might anticipate the need for a specific amount of assets in upcoming years to repay a maturing debt, to possibly cover a contingent loss, or to finance expansion of the facilities. Be sure that you understand that the restriction itself does not set aside cash for the designated event, but it really communicates management's intention not to distribute the stated amount as a dividend. A restriction of retained earnings normally is indicated by a disclosure note to the financial statements. Although rare, a formal journal entry could be used to reclassify a portion of retained earnings to an appropriated retained earnings account. So paying interest to creditors is a contractual obligation. No such legal obligation exists for paying dividends to shareholders. a liability is not recorded until a company's board of directors votes to declare a dividend. In practice, corporations ordinarily try to maintain a stable dividend pattern over time. When directors declare a cash dividend, we reduce retained earnings and we record the liability. Before the payment actually can be made, a listing must be assembled of shareholders entitled to receive that dividend. The specific date is stated as to when the determination will be made of the recipients of the dividend. This date is called the date of record. Registered owners of shares of stock on this date are entitled to receive the dividend, even if they sell those shares prior to the actual cash payment. To be a registered owner of shares on the date of record, an investor must purchase the shares before the ex-dividend date. This date usually is 2 business days before the date of record. Shares purchased on or after the date are purchased ex-dividend, without the right to receive the declared dividend. As a result, the market price of a share typically is going to decline by the amount of the dividend, with other things being equal, on the ex-dividend date. A sufficient balance in retained earnings permits a dividend to be declared. Remember that retained earnings is the shareholder's equity account, representing a dollar claim on assets in general, but not on any specific asset in particular. Sufficient retained earnings does not necessarily ensure that there is sufficient cash to make a payment. These are 2 separate accounts having no necessary connection with one another. So when a dividend is paid from retained earnings, this just means that sufficient assets previously have been earned to pay the dividend without returning invested assets to the shareholders. So as the declaration date, retained earnings is reduced and a liability is recorded. Registered owners of shares on the date of record are entitled to receive the dividend. Now, as mentioned earlier, preferred shares can be cumulative or non-cumulative. Cumulative means that if the specified dividend is not paid for a given year, the unpaid dividends, called dividends in arrears, accumulate and must be made up in a later dividend year before any dividends are paid on common shares. This is an example of that specific type of scenario. So the shareholders' equity account of corporate enterprise includes the items shown below. The board of directors declared dividends of $360,000, $500,000, and $700,000 in its first 3 years of operation. Determine the amount of dividends to be paid to preferred and common shareholders in each of the 3 years, assuming that a preferred stock is cumulative and non-participating. So as you see here, the preferred stock at the 6 million times 8% means in year 1 they're getting the entire dividend. In year 2 they're getting the entire dividend, and then in year 3 they are going to be taking the $580,000 with any excess getting paid only then to the common shareholders. Because cash is the asset most easily divided and distributed to shareholders, most corporate dividends are cash dividends. In concept, any asset can be distributed to shareholders as a dividend. When a non-cash asset is distributed, it is referred to as a property dividend, sometimes called a dividend in kind or a non-reciprocal transfer to owners. Gold Resource Corporation, a Colorado gold mining company, announced in 2014 that it would make dividend payments in gold bullion instead of cash. RFM Corporation conferred a property dividend to its shareholders when it distributed shares of Philippine Townships Inc. stock that RFM was holding as an investment. Securities held as investments are the assets most often distributed due to a relative ease of dividing these assets among shareholders and then determining their fair values. So a property dividend should be recorded at the fair value of the assets to be distributed, measured at the date of declaration. This may require revaluing the asset to fair value prior to recording the dividend. If so, a gain or loss is recognized for the difference between the book value and the fair value. So as you see here, on October 1st, the Board of Directors of Kraft Industries declares a property dividend of 2 million shares of Beeman's Corporation's preferred stock that Kraft had purchased in March as an investment. Book value was at $9 million. Well, the investment shares have a fair value of $5 per share for the $10 million and are payable to shareholders of record October 15th to be distributed on November 1st. So we will debit our investment in Beeman Corporation preferred stock. We credit the gain on the investment. Since the book was 9, the fair value is 10. We're going to, before we issue the dividends or record them, we are going to show the gain. Then from there we debit our retained earnings and we credit property dividends payable. A property dividend should be recorded at the fair value of the assets to be distributed, measured at the date of declaration. This may require revaluing the asset to fair value again prior to recording the dividend. So, as you see, a gain or loss gets recognized for the difference between the book value and the fair value, as I stated earlier. So as again we keep looking here, on the date of record we do not show any entry. That is just merely the date of record. On the payment date, that is when we will debit our dividends payable, and then from there we will credit our investment in Beeman Corporation preferred stock for the difference. Let's look at a concept question here. So as you see, Ellsworth Corporation was organized on January 1st of 2018. The firm was authorized to issue 150,000 shares of $1 par common stock. During 2018, Ellsworth had the following transactions relating to shareholders' equity. Here we show issued 20,000 shares of common stock at $7 per share, then issued 20,000 shares of common stock at $8 per share, then reported a net income of $100,000, paid dividends of $50,000, and purchased 3,000 shares of treasury stock at $10. So I'm going to give you a minute so you can determine what the total shareholders' equity should be at the end of 2018. As you see here, we'll show the issuance of both sets transactions of stock. If we add the net income, subtract the dividends and the treasury stock, we would have a balance of $320,000. Again, the shareholders' equity of Blue Corporation includes $342,000 of $1 par common stock and $530,000 par of 7% cumulative preferred stock. The board of directors of Blue declared a cash dividend of $63,000 in 2018 after paying $33,000 cash dividends in each of 2017 and 16. What is the amount of dividends common shareholders will receive in 2018? And what was the total shareholders' equity at the end of 2018? So as you see, the remainder of the shareholders' equity after the preferred dividends were satisfied, the remainder would be the $17,700. Now we're going to take a look at problem 8-8. During its first year of operations, Coyote Fan Corporation issued 31,000 of $1 par Class B shares for $390,000 on June 30th, 2018. Share issue costs were $1,600. 1 year from the issue date, on July 1st, 2019, the corporation retired 10% of the shares for $40,000. Prepare the journal entry to record the issuance of the shares, the declaration of a $2.10 per share dividend of December 1st, 2018, the payment of the dividend on December 31st, 2018, and the retirement of the shares. So the first, we are going to debit our cash for the difference between the issuance price minus the cost to issue those shares. So $390 minus the cost to issue the shares of $1,600, debit our cash for $388,400. We're going to credit our common stock for just the par value and credit paid in capital excess of par for the difference. Then, when the cash dividends were declared, 31,000 shares times $2.10 would be a debit to retained earnings for $65,100 and a credit to cash dividends payable for the same amount. Then, when they were paid, we're going to debit our payable and credit our cash. on July 1st, we are retiring some of the shares. So we are going to debit the common stock for just the par value. We are going to debit our paid-in capital of excess in par for the 10% of the $357,000. We will, of course, credit our cash for the $40,000, and the difference will be debited to retained earnings. A stock dividend is the distribution of additional shares of stock to current shareholders of the corporation. Note that the contrast between a stock dividend and either a cash or property dividend. A stock dividend affects neither assets nor the liabilities of the firm, because each shareholder receives the same percentage increases in shares. Shareholders' proportional interest in the percentage ownership of the firm remains unchanged. So an example is if a 5% stock dividend is declared, each shareholder will receive additional shares of stock to equal 5% of the shares they currently own. The prescribed accounting treatment of a stock dividend requires that shareholders' equity items be classified by reducing one or more shareholders' equity accounts and simultaneously increasing one or more paid-in capital accounts. So the amount reclassified depends on the size of the stock dividend. For a small stock dividend, typically less than 25%, the fair value of the additional shares distributed is transferred from retained earnings to paid-in capital. A small stock dividend requires reclassification to paid-in capital of retained earnings equal to the fair value of the additional shares distributed. As a Kraft shareholder owning 10 shares at the time of the 10% stock dividend, you would receive an 11th share. Since each is worth $12, you would benefit by $12 when you receive the additional share from Kraft. Would you? No. If the value of each share were to remain $12 when the 10 million new shares are distributed, the total market value of the company would grow by 120 million, which is not the way it's happening. Excuse me, I have dogs sitting on my lap if you wonder what that noise is. A corporation cannot increase its market value simply by distributing additional stock certificates. Because all shareholders receive the same percentage increase in their respective holdings, you and all the other shareholders still would own the same percentage of the company as before the distribution. So the per share value of your shares would decline from $12 to $10.91, so that your 11 shares would be worth $120, exactly what your 10 shares were worth prior to the stock dividend. You might compare Kraft Industries to a pizza. Cutting the pizza into 16 slices instead of 12 slices doesn't create more to eat. You still have the same pizza, just a higher number of smaller slices. Any failure of the stock price to actually adjust in proportion to the additional shares issued probably would be due to information other than the distribution reaching shareholders at the same time. Early rulemakers felt that per-share market prices do not adjust in response to an increase in the number of shares. Then what justification is there for recording the additional shares at market value? In 1941, and then again reaffirmed in 1953, accounting rule makers felt that many shareholders are deceived by small stock dividends, believing they benefit by the market value of the additional shares. Furthermore, they erroneously felt that these individual beliefs are collectively reflected in the stock market by per-share prices that remained unchanged by stock dividends. So consequently, their prescribed accounting treatment is to reduce retained earnings by the same amount as if cash dividends were paid equal to the market value of the shares issued. This obsolete reasoning is inconsistent with our earlier conclusion that the market price per share will decline in approximate proportion to the increase in the amount of shares distributed. Our intuitive conclusion is supported also by formal research. Besides being based on fallacious reasoning, accounting for stock dividends by artificially reclassifying earned capital as invested capital conflicts with the reporting objective of reporting shareholders' equity by source. But despite these limitations, the outdated accounting standard still applies. Since neither the corporation nor its shareholders really benefit from stock dividends, then why do companies declare them? Occasionally, a company tries to give shareholders the illusion that they are receiving a real dividend, while another reason's merely to enable the corporation to take advantage of the accepted accounting practice of capitalizing retained earnings. A company may wish to reduce an existing balance in retained earnings, otherwise available for cash dividends, so it can reinvest the earned assets represented by that balance without carrying a large balance in retained earnings. A frequent reason for issuing a stock dividend is actually to induce the per-share market price decline that follows. So, for instance, after a company declares a 100% stock dividend on 100 million shares of common stock with a per-share market price of $12, it then has 200 million shares, each with an approximate market value of $6. The motivation for reducing the per-share market price is to increase the stock's marketability by making it attractive to a larger number of potential investors. A large stock dividend is known as a stock split. A stock distribution of 25% or higher can be accounted for in one of two ways: as a large stock dividend or as a stock split. So a 100% stock dividend could be labeled a 2-for-1 stock split and accounted for as such. Conceptually, the proper accounting treatment of a stock dividend is to make no journal entry. This, in fact, is the prescribed accounting treatment for a stock split. Since the same common stock account balance, total par, represents twice as many shares in a 2-for-1 stock split, the par value per share will be reduced by 1/2. In this previous example, if the par were $1 per share before the stock distribution, then after the 2-for-1 stock split, the par would be 50 cents per share. As you might expect, having the par value per share change in this way is expensive and is cumbersome in paperwork. So all records, printed or electronic, that refer to the previous amount have to be changed to reflect the new amount. The practical solution is to account for the large stock distribution as a stock dividend rather than a stock split. So to avoid changing the per share par value of the shares, the stock distribution is referred to as a stock split effected in the form of a stock dividend, or simply, it's a stock dividend. So in that case, a journal entry increases the common stock account by the par value of the additional shares. To avoid reducing retained earnings in these instances, most companies reduce, which would be debit, paid in capital, excess of par, to offset the credit to common stock. Note that this entry does not reclassify earned capital as invested capital. Some companies choose to debit retained earnings, though, instead. Netflix described a stock split in its disclosure notes, as you see here on this slide. In 2015, Netflix distributed a rare 7-for-1 stock split that dropped the price of Netflix shares from about $700 all the way down to $100. Now, a reverse stock split occurs when a company decreases rather than increases its outstanding shares. After a 1-for-4 reverse stock split, for example, 100 million shares, $1 par per share, would become 25 million shares, $4 par per share. No journal entry is necessary. The market price per share, theoretically, would quadruple, which usually is the motivation for declaring a reverse stock split. Companies that reverse stock split their shares frequently are struggling companies. They're trying to accomplish with the split what the market has been unwilling to do, which is increase the stock price. Often this is to prevent the stock's price from becoming so low that it gets delisted from a market exchange. Reverse splits are not unusual occurrences, particularly during stock market downturns. In 2014, Great American Group declared a 1-for-20 reverse split. Typically, a stock dividend or stock split results in some shareholders being entitled to fractions of whole shares. So, for example, if a company declares a 25% stock dividend, or equivalently a 5-for-4 stock split, a shareholder owning 10 shares should be entitled to an additional 2.5 shares. Another shareholder with 15 shares would be entitled to 3 3/4 shares. Cash payments usually are made to shareholders for those fractional shares, and they're called cash in lieu of payments. Cash payments usually are made to shareholders for fractional shares and are called these cash in lieu. In the situation that you see, if the market price at declaration is $12 per share, the shareholder with 15 shares would receive 3 additional shares and $9 in cash. So let's look at a concept question here. The following data were reported in the shareholders' equity section of the Brandon Industries comparative balance sheets for the years ended December 31st. So you see common stock, $1 par per share, paid in capital, excess of par, and retained earnings. During 2018, Brandon declared and paid cash dividends of $45 million. The company also issued a stock dividend. No other changes occurred in shares outstanding during 2018. What was Brandon's net income for 2018? As you see here, the retained earnings in 2017 were $300. We know the cash dividend was $45 and the stock dividend was $30. If we had the retained earning balance at the end of 2018 for $314, we could plug in our net income of $89. So as you see here, the retained earnings total of $30 is subtracted from the common stock of $306 minus the $300, and then the paid-in capital of $174 minus the $150, which is the $24, which is how you know the stock dividend here was $30. Here's another one. Richard Company had 25 million shares of $2 par common stock outstanding at January 1st, 2018. In October of 2018, Richard Company's board of directors declared and distributed a 2% common stock dividend when the market value of its common stock was $64 per share. In recording the transaction, Richard would A. credit common stock for $32 million, debit retained earnings for $32 million. C. None of these answers would be correct. Or D. Credit paid-in capital excess of par for $32 million. The 2 times 25, 0.02 times 25 would be 500,000 shares. Those 500,000 shares at $64 per share would be $32 million. That would be debited from retained earnings. Typically, a stock dividend or stock split results in some shareholders be entitled to fractions of whole shares. So in this scenario, if a company declares a 25% stock dividend or equivalently a 5-for-4 stock split, the shareholder owning 10 shares is going to be entitled to 2.5 shares. Then the one with 15 shares would be entitled to 3 3/4 shares. Cash payments usually are made to shareholders for fractional shares. Cash payments usually are made to shareholders for those fractional shares called cash in lieu payments. So as you see here, this situation, if the market price at the declaration is $12 per share, the shareholder with 15 shares would receive 3 additional shares and $9 in lieu of, or in cash, the 12 times 3/4. Let's look at problem 1811. Evan Transport Company acquired 1.5 million shares of stock in L&K Corporation at $99 per share. They're classified by Evan as available for sale. Evan sold 500,000 shares at $100, received a 10% stock dividend, and then later in the year sold another 100,000 shares at $98. There is no entry for the stock dividend, but a new investment per share must be calculated for use later when the shares are sold. Prepare the journal entries to record these transactions. So, the first, the investment in L&K Corporation shares, the 1.5 million at 99 per share is 148.5 million. Credit our cash for the same. Then, when they sold 500 shares at 100, we would debit the 50. We would credit our investment in L&K Corporation, the 500,000 shares times 99 bucks a share for 49.5, and we would credit our gain on the sale of investment for 0.5. Then, when they sold another 100,000 shares for 98, we're going to show the cash of 9.8, the investment in L&K Corporation shares of 9, and the gain on the sale of investments for 0.8. In this scenario, with the 0.8, the way this is calculated is the 10% stock dividend. We need to readjust the price per share. So the 99 million, divide that by 1 million shares, is 90 bucks per share. The 148.50 minus the 49.50 gives us 99. So to record the shares, we're going to take the 100,000 shares at 98 bucks, but our investment in the LK shares, the 100,000 shares is now worth 90 bucks per share, since we need to adjust our cost basis based on the stock dividend. Let's look at problem 8-6. So in 8-6, we have comparative statements of stockholders' equity for Anaconda International Corporation were reported as follows for the fiscal years ending December 31st of 2018, 2019, and 2020. Our job here is to infer from the statements the events and transactions that affected Anaconda International Corporation's shareholders' equity during 18, 19, and 20 years, the 20 tax years. Prepare the journal entries that reflect those events and transactions, and then finally prepare the shareholders' equity section of Anaconda's comparative balance sheets at December 31st, 2020 and 2019. So, in 2018, the first transaction would be the debit to cash for $960, credit to preferred stock, that's going to be 1 million shares at $20 par per share, and then the difference is going to go to paid-in capital in excess of par. So if we go back here and look at 2018, 2019, and 2020, you see here the sale of preferred shares at the par value 20 and the additional paid-in capital of $940. So that is the first transaction. The second transaction is for the issuance of common stock. We would debit our cash for $60. We would credit the common stock for par, $1 par at $6, and credit paid-in capital in excess of par for $54. If we go back here and look, you'll see in 2018 the shares of common stock, 6, and additional paid-in capital of $54. Then the next transaction in 18 would be the debit to retained earnings for 2 and the credit for cash dividends payable preferred for 2. We would then have to debit our payable and credit our cash when in fact that is paid. We can see that from the cash dividend preferred here of $2. Next, the common stock dividend. We would debit our retained earnings for 17, credit our cash dividends payable for common stock. Then number 6 here, we would debit our payable, credit our cash. You can see the dividend here of 17. Then the income summary, we would debit for $270 and credit our retained earnings for $270. For 2019, it looks as though we retired some stock. Let me look here. We've got debit to common stock for $9 million. Again, that's the $1 par. We're going to debit paid-in capital in excess of par for $81. Now, the way we figure that, 9 million shares times $9 a share is 81. The 675 million plus the 54 million, divide that by the 75 plus the 6 million shares, gives us a $9 weighted average amount per share in excess of par. Of course, we credit our cash for 100, and we will debit retained earnings for the remainder. Next, you see that, that was, in 2019. Next, we need to deal with the preferred stock dividend and the common stock dividend. The preferred stock dividend would be a debit to retained earnings of $2 million, credit cash dividends payable preferred $2 million. Then, when we pay it, we debit our payable and we credit our cash. For the common stock dividend, we debit retained earnings for $21 million, and we would also credit our cash dividends payable for $21 million. Then, when we pay it, we debit our $21 million and credit our cash. In 2019, let me go back here, we have a 3-for-2 split affected in the form of a dividend for the preferred stockholders. So we will debit our paid-in capital, excess of par, and credit our preferred stock. Our income summary on 19 is debit our income summary for 420 and credit our retained earnings for 420. Then let's look at 2020. In 2020, we had a common stock dividend, a cash dividend for preferred, and a cash dividend for common. So we will debit our retained earnings for the first thing we're going to do is debit our retained earnings here for 65. We credit our common stock for 6, and we're going to credit our paid in capital, the excess of par, for 59. Then for the dividend, the cash dividend, we'll debit our retained earnings and credit our payable. Again, when it's paid, we'll debit our payable and credit our cash. Same is true for our common stock dividend. Debit our retained earnings for 23, credit our payable for 23. Then when we pay it, we debit our our payable and credit our cash. And then finally, we debit our income summary for the 462 and we credit our retained earnings for 462. The balance sheet at the end of 2019 and 2020, our preferred stock is at 30. Our common stock at the end of 2019 is 72. At the end of 20, it's 78. The additional paid-in capital, again, the job here is to just post the journal entries. 1578. Additional paid-in capital in 20 is 1637. Our retained earnings, 2344. In 19 and 20 is 2716. Well, there you have it, guys. This covers Chapter 18.